Um, Good morning, everyone. A little bit of technical difficulties this morning, but luckily almost everybody's here with us. I'm going to call the meeting to order. Welcome to the virtual April 5th, 2021 special meeting of the West Hartford Pension Board. My name is Nancy Dean, and I am chair of the board. Because in-person attendance at public meetings is likely to increase the risk of transmission of COVID-19, this meeting is being conducted in accordance with Government Lamont's Executive Order Number 7B, which permits municipalities to conduct public meetings virtually. Members of the Pension Board and some town staff are participating by WebEx, and members of the public can view this meeting live on West Hartford Community Television or on West Hartford Community Interactive Comcast Channel 5 and Frontier TV Channel 6098, or at www.hctv.org. The meeting is also being recorded for on-demand viewing, which will be available on the town's website. Because of the virtual format, there are some special rules and procedures that I need to cover before I begin. First, I ask that all participants to please mute your devices when you are not speaking. If you wish to be recognized, please raise your hand and I will call on you in the order I see hands go up. If you are participating via audio only or I do not call on you and debate is ending, then please unmute your phone and let me know so that I may recognize you. Second, main motions will be made by me and no second is necessary. We will proceed immediately to debate. These include motions to adopt, receive, or approve business items. Subsidiary motions will require a second. These include motion to amend. A member must be recognized before making a subsidiary motion, but any member can second the motion by just unmuting their line and saying second. Third, pursuant to Executive Order 7B, all speakers must state their name and title each time they speak. Fourth, because of the difficulty in tallying voice votes on a video conference, I will require that all votes will be taken by roll. And Lori Carney will be, as always, assisting me in that regard. And as a reminder, if any participant has a problem with their connection, you should immediately call Lori, whose phone number you have. She will let me know and we will recess the meeting while the problem is resolved. If it cannot be resolved quickly, then I will ask you to call in the meeting using your phone and participate by audio only. And with that, I would ask Lori to please call the roll.
Thanks, Nancy. Nancy Dean.
Present.
Lazaro Guzman.
Present.
Al Lebo.
Here.
Ethan Goldman.
Here.
Peter Privitera.
Here.
And Brittany Birmingham is absent. Mayor Cantor.
Here.
Chris Kachmar.
Here.
Rick Ledwith.
Here.
Lee Gold.
Here.
Jennifer Evans is recording. Becky Sielman.
Here.
Yelena Pelletier.
Here.
Is there anyone participating whose name I have not called? Okay, Nancy, thank you.
Okay, thank you, Lori, and good morning to all again. I wanted to thank you for attending this morning. I also wanted to especially thank Lazaro for stepping in for me at last month's or a few weeks ago meeting, and I've read those minutes and been able to follow up on all the good work that Alan and Becky and Yelena have done from Milliman. So I appreciate everyone's help in that regard. For the first order of business, we do have the minutes of that meeting of April 5th. I know those were circulated. No, excuse me. Today is April 5th, the meeting on February 22nd. I will make a motion to approve those minutes, but I would open it for discussion if there are any comments or corrections. Hearing none, I'll make a motion to approve. All those in favor, please say aye.
Aye. Aye.
Well, let me
Oh,
let me run.
I'm sorry. Yes, Lori, I took Lori's job away from her. See what happens when I'm not here for a while. Lori, please take the vote.
Okay. Peter?
Aye.
Ethan?
Aye.
Al?
Aye.
Lazaro?
Aye.
And Nancy?
I have to pass.
Okay, in Brittany's absence, so there's four in favor, so the motion carries.
Okay, great. Okay, thank you. The primary purpose of our meeting this morning is to continue the follow-up regarding additional scenarios. I know that we've been able to send a lot of the material that the folks from Milliman have helped prepare for us, and I think Peter is going to give us an introductory to that process. Peter?
Morning, everyone. Thank you. I know that Al has been working closely with Yelena and Becky on the various scenarios that he asked to be prepared, as well as some other scenarios that other members asked to be prepared. So since Al took the lead on this, I'm going to defer to Al and with Becky and Yelena for an overview of the different scenarios that Milliman completed. Thank you.
Thank you, Peter. This is Al Lebo, member of the pension board. First of all, thank you to Becky and Milliman and Yelena for providing these scenarios. It's extremely interesting to be able to, review these and see how everything works on a year-by-year basis. If it's okay and if this technology works, I'd like to share my screen. Does the chair have any objection to that?
No objection.
All right, well, let's see if I can actually figure out how to do this. Is that coming through?
Yes.
Okay. For some reason I can't really see exactly what I'm sharing, but okay. All right, so hopefully you're all seeing this screen that says Town of West Hartford Pension Plan 1/8/2021.
Yes. Yeah.
Okay. All right. So this exhibit here is an exhibit from a presentation that was made to the pension board on January 15th. And it was made, I think, to the town council shortly after that. So, the whole idea of the pension obligation bonds is that we're going to borrow money through the sale of pension obligation bonds at hopefully a low rate, reinvest that in risk assets at a higher rate, and over the long term earn a return on that we use then to reduce the cost to the town of funding the pension plan. So this example here shows, if we issue $365 million worth of pension bonds, and you can see that right here, the 215 becomes 280. That's the infusion of $365 million. That money then gets repaid in 25 equal annual installments of roughly $21 million, which is shown here. Implicit in that is the 3% return on those bonds, and then we're going to reinvest that money, and we're going to earn 6.25% every year, with the exception of the first couple of years here. There's this dollar cost averaging, and therefore the amount of return is a little bit less. And if this all goes as planned, the town. By the way, are you seeing my cursor when I'm? Okay.
Yes.
All right. So the cost to the town, which otherwise would be this, becomes this. And so there's a savings to the town that grows each year. And on a present value basis, there's a savings of $140 million. One other thing I'd like to point out is that without the pension obligation bonds, the cost to the town, which starts out here at 25 million, grows to 50 million. That's roughly a 3% increase per year. And that's a consequence of our amortization method on the pension obligation, and a growth rate assumption, amortization growth rate assumption that's inherent in that of 2.75%. So again, this is the intent of the pension obligation bonds. Now, what we had asked Milliman to do was to give us a number of deterministic or what-if scenarios. So these aren't necessarily likely scenarios. These are scenarios as to, you know, if a certain situation occurs, what would that mean? So the first of these is what I've listed here as drop and recover. And the idea here is that shortly after we're fully invested in the pension plan, there's a large sharp drop in the stock market. In this case, a 50% drop, and subsequent to that drop, things sort of return to normal. You see this 6% return here, 6.2% return per year. I'm ready.
Thank you, Alan. Thank you. Okay.
All right,
Or I
thank you.
think oh, wait a minute. Was Becky speaking? I'm not sure who was speaking, Becky or Alan at the moment. That was Nancy speaking.
Well, I was speaking. I'm not sure exactly when the internet went down. But let me summarize. Becky was pointing out that there is a slight difference here between the scenarios I'm showing, which shows 6.2% annual return, and the 6.25 in the level scenario. And what I was saying was the way I had come up with it, or we had come up with a 6.2, was that it assumed an 8% equity return per year and a 2% money market and bond fund return and a 70-30 mix. And so that had come up with 6.2, which was pretty close to what had been used before, 6.25. So I was satisfied that, that we were sort of on the same page there. So this particular scenario shows that same 35% drop, early on, but then assumes that it takes a while for the markets to recover. And of course, what that means is that there's a further sort of negative implication to that. So, not terribly surprising that, if you borrow a whole bunch of money and you immediately lose that money, it costs you some money. So not a terrible surprise here, but interesting to see, what this means. The next scenario that we looked at was a flat 3% scenario. So in this scenario, we get a 3% return in every year. The purpose of this scenario was sort of twofold. One was to say, if you borrow at 3% and you earn at 3%, you would think there shouldn't be much of an impact. And that's really what we see. Overall, there's very little impact. There's a little bit of a timing difference here where we get some gains in the beginning and some losses at the end. But it works pretty much as you would assume. And so that gives us some reassurance that the model is working as expected. The other thing that this does, though, is it says, well, if you were to try to avoid that big loss, if you were scared by that big loss that we showed in the earlier scenario, and avoid that by investing, extremely conservatively, so that you're not in equities and don't lose any money, what would be the consequence of that? And the consequence of that would be the pension bonds don't help you at all, and your costs go from 25 million to 80 million. So obviously not a terrific way to handle that. This next scenario is sort of a real life example. So the question here was, well, okay, sure, we've taken a look at some specific, scenarios. what if the market sort of repeated what happened in the years 2000 through 2020? And you can see in here, this is the 2001 to 2003 market downturn, and this is the 2008 and 9, or 2007 and 8 market downturn. And then here are the recoveries in between. And the interesting thing to me about this scenario was it actually came out fairly even. The pension obligation bonds wouldn't have made a whole lot of difference in this 20-year period. And even on a year-by-year basis, it didn't impact earnings that much. But it was, a favorable outcome overall. So this last scenario was to take a look at the other extreme. This assumed that we have 12% equity market returns every year, 5% money market and bond fund returns. And so you end up with almost a 10% return per year here. And as often happens with financial instruments, you get some results that aren't exactly what you expected. The thing that happens here is that the town's cost, which otherwise would have tapered off here, continue on because we have to refund the pension obligation bonds. And so there's a little bit of an uptick at the end here under the pension obligation bonds. Overall, not much difference, but the funding ratio of the pension plan actually gets almost to 400%. So you can see here, the accrued liability at the end is $800 million, but the market value of the assets is $3.7 million. So we end up with quite a bit of overfunding in this scenario. So there are a couple more scenarios I wanted to show, and then wanted to make some overall comments. In addition to the deterministic scenarios that Milliman ran for us, we asked them to look through their stochastic, the 10,000 stochastic scenarios that they ran, and find a couple of specific situations for us. And in particular, the one situation that I really wanted to take a look at was, is there a situation where overall pension obligation bonds look like they're, really beneficial to us in terms of a net present value down here that's quite positive. But in the interim, what we're seeing is maybe, the town has to pay $100 million a year here and then recovers it, here. And so that's what I was concerned about, is do we have scenarios which overall look like they're good, but if you really dig into them, there's a situation. And the result was no, that is not, that doesn't happen. This obviously isn't the situation we were specifically looking for because there were some technical issues. This overall is a bad scenario, and you can see it's a bad scenario because there's quite a bit of losses here. But even in this situation where there are terrible losses at the beginning, it's not like the town ends up paying, tremendous amounts of money here. Now, obviously our costs do go up in this kind of scenario, and we end up, paying quite a bit by the end. The last scenario I wanted to point out here, we had asked Milliman, tell us about one of the worst scenarios, and so here's one of the worst scenarios, $200 million worth of loss. And interestingly enough, it is this same situation we saw earlier. This is actually a very favorable scenario. Very large gains, some little area here where there's sort of, flat, but gains, pretty much throughout. And in this situation, without the pension obligation bonds, the town's cost would actually become zero out here. But with the pension obligation bonds, we still have the bonds to repay. And therefore, the cost of the bonds is actually negative. There is a cost to having the bonds. And what happens here is the funding ratio becomes 634%. Again, that same 813 million gets funded with assets of $5 million, $5 billion. So again, the situation here is that we end up with overfunding. So,
this is Becky. Can I chime in?
Sure.
Please.
It is in these scenarios that end up with a pension plan being very, very overfunded, I just want to point out that the reserve fund statute, ordinance rather, did include a provision for the reserve fund being released to the town if the stochastic modeling indicated that the pension plan was fine without it, in effect, or that the reserve fund could be used to pay the debt service. And we haven't reflected that in any of these scenarios. We've assumed the reserve fund continues to operate intact, but as a practical matter, in a scenario like this, I'm sure that the town would move to use the reserve fund to cut down on the town's cost.
Thank you, Becky. I do believe, though, that this money here is actually not in the reserve fund. This money is locked into the pension plan.
That's
Okay,
correct. But when we look at the town's cost, you'll see that the town is paying debt service every year, and as a practical matter, at least the reserve funds that are available would likely be used to help offset that. So it would help.
Yeah. Well, right. So in this scenario, you have a $200 million cost offset by a $60 million reserve balance fund. Of course, this is a scenario where we would be delighted to be in this situation because our overall cost was, $400 million instead of something much larger that we saw in earlier scenarios.
Can I ask a question? I'm sorry.
Yes, please, Len. Yeah.
I forget, are the POBs prepayable? So can we prepay them if we, at some point, if we wanted to, could we prepay the bonds?
Yeah, we could. Sorry, I'm just having an issue with my computer here. Yeah, we could, but I just want to, I just want to comment, Al. I hear what you're saying, and I'm looking at all these negative scenarios, and especially scenario number 2, where you have a 50% drop in equity, and then 4 years after that, absolutely no growth whatsoever, which, I kind of find hard to believe. I can't believe that it would be a 5 years of almost negative growth where the feds wouldn't step in and inject some stimulus or something into the economy. So I just want to comment that, yeah, these are all negative scenarios. These scenarios that you're showing are a handful of scenarios, but there were 10,000 scenarios that were run, and I'm assuming that, and I'll let Becky chime in on this. I'm assuming that there are some scenarios that show that the growth rate is higher than what we projected, and our asset growth rate is very conservative. So I just want to caution everyone that we're going to be selling these bonds, and it's good to know what the worst case scenario is, but it's also good to know what a good case scenario is. And I think our asset growth rate on average over the last 10 years has been over 9%, and over the last 20 years has been, I think, 6.7%. So, I just want to throw that out there because it's not all doom and gloom. There are some positive points here. So, with that, I'll pass it back to you. Thank you.
Thank you, Peter. And I appreciate your comments there. Certainly the intent here was not to say this is all doom and gloom. The intent here is to take a look at what things do we need to be concerned about, and what does that mean, for our investment strategy. And so we took a look at specific scenarios, which are sort of doom and gloom scenarios. Now, before I turn this back to the chair, there are maybe 4 takeaways that I have, as I look at this. The first one is that, in many respects, as far as our investment strategy goes, I'm not sure that this changes anything. Today, we, are investing hundreds of millions of dollars. After we sell pension obligation bonds, we'll still be, managing hundreds of millions of dollars. In either case, what we need to do is to understand our risk tolerance and come up with an investment profile that maximizes our returns and minimizes our risks within that risk tolerance. The only thing that I really take away here is that we will have more money to invest, and we won't have the need to make up that funding gap that we have right now, where our funding ratio is like at 40%. And so both of those things say maybe our risk tolerance could be a little bit lower, and we could be slightly more conservative in the way that we're investing. But other than that, I'm not sure, to me, that this suggests a whole lot of changes in our investment strategy. The one thing I did want to mention, though, is dollar cost averaging. We've talked about this, and of course, there's built into the pension obligation strategy here was built in this 18-month dollar cost averaging. And when I first started looking into these scenarios, I was thinking that we might want to stretch that out and make that a longer period of time. After going through this and looking it over, I actually would recommend that we not increase that period of time. Obviously, if the market drops in the near future and we aren't, the longer we use the dollar cost averaging, the more protection that is against the downturn, but it also sort of is negating the whole pension obligation strategy. And if you believe the pension obligation strategy is the right way to go, then getting fully funded and moving on with that strategy is the right thing to do. There are two other takeaways, though, that I really like to mention here. The first one is I do think once we've got the pension obligations in place, I really think we should revisit our strategy for funding the past service costs. As I pointed out here, even at the very beginning, the cost of the town goes from 25 million to 50 million here. It's more level here, but there's a 30-year amortization strategy here with a 2.75% built-in increase. And I do think once we've sold the pension obligation bonds and we've closed that funding gap, the need to have that 30-year amortization period sort of isn't there anymore. And I would suggest that we revisit how we handle shortfalls in the funding ratio when they occur in the future. The second thing that I would suggest that the pension board consider is right now the way the strategy is set up is that we continue to pay the normal cost up until the funded ratio reaches 150%, and at that point, we start a funding holiday. I would suggest that number might be 100% rather than 150. That doesn't mean that the town, doesn't necessarily provide for. The town could take that money and put it in, the reserve fund or something like that, to make sure that there's no issues with the pension plan. But I do think that, as long as we're at 100% funding ratio, continuing to put more money into the plan and potentially, getting up to these 600% ratios and things like that isn't necessarily the thing to do. So with that, Nancy, I'll turn the floor to you.
Okay. Would you like to take down that from the screen, or?
Yes, thank you.
Thank you. Okay, Nancy Dean speaking. Thank you very much, Alan. Thank you, Becky and Yelena, for the many scenarios and the thoughtfulness that it took to for all three of you, and actually for the full board. But I know Alan was speaking as the spokesperson for us to look and peel the onion back. It's an important process for us here, and I think that it is very. I'm not an actuary, but it's very comforting after all this additional due diligence into the models that that there is strength in the process. So I thank you very much, Becky and Yelena, for your help in that. And so going forward, we do have, are there any questions for Alan from the rest of us on the committee here? Last, please.
Yeah, I had one question. It was more for Becky and Yelena. Can you just remind us, out of the 10,000 scenarios, what percentage were a benefit to the town?
It depends on what you define as a benefit. He was very interested in the number of scenarios in which the reserve fund still had funds left, and that was a very, very strong, more than 97% of the scenarios. There was still reserve fund money left over at the end of the projection period, which indicates that there was a robust mechanism for helping protect the town against budgetary volatility. So that's one way of looking at a positive scenario, positive outcome for the town. Another lens that you could use for looking at what is a positive outcome for the town is the number of scenarios where the net present value was lower with the pension obligation bond than without. And I don't know that we actually counted that up. It's another lens, and we could get that number for you for the 10,000 scenarios. I think it's interesting, as Al pointed out, and I wanted to make sure that this didn't just kind of go by. They're two very, very different kinds of circumstances under which the pension obligation bond would cost the town more money than not having one. And they're at both extremes. They're the extreme, as you might expect, of when the market does abysmally poorly and you end up having an underfunded pension plan, plus you have to make debt service. But the other extreme, it also costs the town more money, and the extreme is where the markets do phenomenally well and the plan becomes wildly overfunded. And you can't take surplus out of the pension plan. And so you'd be in a situation where the plan would have become fully funded anyway without a pension obligation bond, and yet the town still has to pay the debt service. And I think that's what I was getting at with his comments at the very end there. You know, maybe you should not have the conservative strategy of continuing to fund the normal cost when the plan is modestly overfunded, because though that would exacerbate a situation where the markets end up doing very well and the plan gets wildly overfunded. If the plan is only going to get modestly overfunded, the strategy of funding the normal cost is a sound one, because it's a cushion, and that helps with budgetary stability. Al mentioned, well, perhaps that you could fund the normal cost, but it would go into the reserve fund rather than the pension trust. And I think that's a very interesting idea, because you have more control, more ability to take funds back out of the reserve fund than you have ability to take funds out of the pension trust. There are a lot of variations on the theme that you could construct. And of course, the right thing to construct, we will only know after 30 years, looking backwards to know how the markets actually performed. So that was a very long answer to it, and I didn't actually answer the specific question you sent me. We can get that answer for you.
Yeah, and if the pension plan got wildly overfunded, I get that it would cost us more during that period that we're looking at, but in reality, doesn't that extra surplus give the town an ability to not contribute in the future? So monies that they would have had to contribute and a cost that would have hit the town in future years beyond the projection period, those become savings to the plan because now they are surplus. They can be taken from the surplus from the assets, correct?
Absolutely, yeah, absolutely.
Okay.
And we stopped counting at the end of 30
Right.
years. But,
Yeah.
But that surplus in the plan would then benefit the town for hopefully generations afterwards.
Okay. Thank you.
Alan, did I see you raise your hand?
Yeah, Al Lebo, pension board member. Lazar, I just wanted to caution one thing on that you know, what did the scenario, what the percentages of favorable scenarios showed. The 10,000 scenarios that were run used a very simplistic scenario generator that assumed a normal distribution of outcomes, and it was a shape that you know, investment professionals wouldn't necessarily say is indicative of what the economy might look like. And if you used a scenario that had more of a skew to it, a chi-square kind of shape to it, and fatter tails and a number of other changes to it, the outcome would have been quite different. So I just caution that, you know, in looking at the percentage of, you know, the 10,000 scenarios, that's fully a function of the shape of the scenarios that were generated. And if I were you, I would look more at, you know, specific types of scenarios and what you think of those.
Yeah, no, I get it. I want to think about everything though. I get that I understand what you're saying, but thanks.
Okay. This is Nancy. Peter?
Yeah, I just wanted to point out a couple of things. Number one, the reserve fund is not part of pension assets. That's controlled by the town council. So any change to funding levels or any change to policy would have to be approved by town council. I also wanted to point out in the past, the pension fund was significantly overfunded. And what had happened in the past was, because it was significantly overfunded, there were a number of pension holidays and money used for other purposes, and that's why we are where we are today.
Right.
You know, it's important to also, I mean, I can sit here and say that, Al, you ran all these scenarios, but we all know that nobody knows what's going to happen until it happens. All right. All we know for certain is what our history is and what our past is, and we try to grow on that and move to the future. And I think one of the reasons why we were comfortable with our projections is because for the last 20 years, we've been measuring our success and our losses, and the averages look favorable. So, you know, I mean, we're already there. You know, we've already committed to this, and you know, it's good to know what could happen, but we don't know what's going to happen until it happens. And you know, to say that, well, this is just a very simplistic model, you know, it just kind of, it takes away from all the work that we've done on this thing. And I just want to point out that, you know, we're not going into this with blinders on. We're going into this with our eyes wide open, and we've had a lot of input, and we've had a lot of conversations, and we've also had, you know, some affirmation from the credit rating agencies who don't take this lightly. So I just want to make sure that, you know, just so everyone understands that this is not, you know, it's not something that we called up Becky and said, Becky, just run 10,000 scenarios, and hey, you know, great, thumbs up, it looks good. We're ready to commit the town to $350 million of liabilities. No, there's a lot more than went into this. I think it is important that we do need to understand what the worst case scenarios are to prepare for them if possible. But we also need to understand that there were a lot of scenarios that were presented that were very positive for the town. And I think that, you know, I think that the decisions that were made, we took everything into consideration, and we decided to council decided to move forward on this. So again, just wanted to point out, any changes to the reserve fund policy has to come from the town council. But you know, we're here to talk about, you know, how we're going to invest this money in the future, and how we're going to basically do as much as we can to achieve that 6.25% on average growth rate over the term of these bonds. And so I think we should talk about, you know, is there going to be any change in our short-term investment strategy? Related to Al's comments, Al said that he thinks we should just not change our investment strategy and move forward. But I think that we need to talk about that, because frankly, probably next week sometime, we should be getting a letter from the state of Connecticut saying, okay, you're good to go, and we're going to be good to go, and we need to be ready for when that transaction is executed. Thank you.
Thank you, Peter. I think it is important that we keep all components of this process in perspective, both the testing, both the setup, both the research, all of the many pieces that have gone into it, and all of them are important. And it's been worth the time spent. And with that, I wanted to, Ethan, you have any questions before we move forward? We do have Chris here with us this morning to talk about some additional information on the investment side, but relative to any of these other pieces of discussion this morning, is there anything that you'd like to add? You're muted. Unmute yourself.
I had a hard time bringing the mouse back out of the other screens. I was good with the presentation. I had a couple general questions. I don't know if that's the appropriate meeting or the time. If I could ask those, I'd like to do that.
Well, I asked if there were any additional questions, so please feel free. But you know, we do want to be mindful of our time. So.
Yes. So just quick question to Peter is I assume we're still tracking 3% or below in interest rates, and if there's a prospectus, do we get to look at it before it goes out or when it goes out?
Yeah, we're still tracking below 3% on the rates. I'm hoping that when we actually execute the deal, we're closer to like 2.5 to 2.6. With regard to a perspective, where there's an official statement that is prepared before the bond sale, a preliminary official statement, and I can share that with the board. All that is it basically provides all the information related to the town, you know, our outstanding debt, our financial condition, everything that an investor would want to know about the town of West Hartford before, you know, purchasing bonds. But we're also going to, since this is a significant sale, we're also going to be preparing a presentation material for prospective bond buyers prior to the sale as well.
That's what I said. So then my last question or comment or request is that it's hard for me. I don't see I see the schedules that we get for Milliman, but there should be a base case. I'd like to be able to see what it is, know how we're doing against it, and measure against it. I just think that's standard type, or to me, it's standard how I'm used to doing things. So if there's some way we can set up like a dashboard or some kind of tracking to track to, I know we measure against how the market does, but not, this is, you're putting out 360 million. We should be knowing how we're doing regardless of how the market does. And I'm good. Thank you for calling me.
Thank you, Ethan. I know that we've gone back and forth a couple times about additional ways to watch the performance of the fund and the balances as we watch. I think that we will refine some of those dashboard type things as we go throughout this session.
I think that's important. Thanks.
Yeah. Okay. Any other questions in this regard? Thank you, Peter. Good.
No, I'm all set. Thank you.
Great. All right. Madam Mayor or Rick, anybody else have any other questions before we look to Chris?
No, I just want to thank everyone for, you know, Alan, I appreciate the look at the worst case scenarios, and it actually gives me more confidence that this is absolutely the right decision. So I appreciate that. And I do also will just emphasize that the fact that the reserve policy is being made with a lot of unknowns ahead of us, and that can be changed. So that is just a matter of we don't want the town in an overfunding situation to be penalizing taxpayers if the markets are doing great. And that is something that can be addressed, and a strategy can be reformed by the councils that sit at the time to make sure that we're taking advantage of that. So I think, again, this is a strategic, an important strategic tool for us to use right now, and we're in a good place. And I want to thank everyone for their work on it and foresight and protection of making sure that this is the right thing for us to do. So I have to jump on to another call, so I'm going to go. But again, my sincere appreciation to everyone.
Okay, thank you. Thank you very much. Okay. Chris is on board with us this morning, I think. With his new name, Fiducient. I think you have some information to share with us this morning. We have, I'm hoping that we can finish up by 9 o'clock. So the floor is yours, Chris.
Well, great. Good morning, Madam Chairwoman, and hello, everyone. Good to see folks again. I will do the same as Alan, if it's okay here, Lori. I think it is, right, in terms of content share. Can everyone see my screen okay?
Yes.
Okay, go great. Well, good morning again, and as the chair mentioned, you do see a new name in the upper left-hand corner of the slide deck. This was an effort underway for a couple of months, and it really germinated from the idea that our merger with DeMayo Schneider was actually going even at a more elevated pace than we had first envisioned. You know, in an odd way, I suppose, by given the pandemic, we're not in cars and on planes and traveling and have lots of time to integrate, and that process has gone again ahead of plan, and we obviously have aspirations longer term to have a truly national footprint. So you see a new name here. Importantly, in terms of our interaction with the town and the pension board, absolutely no changes. Same team, same services, same mentality, same resources. Everything's absolutely identical to the way it was. You just see some new collateral here in terms of the backdrop and a new name. So you'll hopefully over time we'll become kind of acclimated to the name, and we'll move forward together. I did want to quickly just give the board a couple of touch points on performance. You'll remember 2020 concluded on a pretty high note in terms of capital market outcomes. And by and large, not exclusively, but by and large, a lot of that pacing has continued into the new calendar year. So you see here in the form of the exhibit on the page, just asset class performance for the first 2 months of 2021. If you can make it out there, the encircled numbers are the February numbers, the bar charts are the year-to-date numbers. So what you do know, the one thing that has been kind of interest, right, is that interest rates have climbed a bit higher in the new year, and generally fixed income returns have been negative in the new calendar year to date. And you see that evidenced in the chart to the left there. Lots of discussion, right, about what's driving rates higher. You can look at stimulus. You can look at the fact that perhaps the economy is poised in the back half of the year to regain momentum. And that would suggest higher rates just with an economic uptick, but in an anticipatory fashion, rates have moved higher, and that has pressured fixed income returns a touch. Equities, you see there in the gray bars to the right side of the exhibit, continue to move higher. And you do see there kind of the large cap, small cap, international equities all positive through February, and that's continued largely through the March month that we just completed. And those trends under hood that we saw at the very end of last year, you'll remember kind of this transition to kind of the more cyclical names doing better, the value names doing better, the small cap area of the market's doing better, has persisted into the new year with some pretty solid returns across equity markets. And given what rates have done, given expectations for an economy reopening, with perhaps inflation ticking a touch higher, the real asset complex is generally, by and large, been positive as well. So the backdrop in the new year has been decent from a return perspective. We just, again, wanted to share with the board a couple of touch points. We'll have more detail for you in coming meetings, of course, with the full-blown analytics. But here's the depiction of the portfolio at the end of March, actually. So you do see there about $263 million of invested assets, and aligned largely with target weights as you see them you'll remember we had done some rebalancing at your direction not too long ago, so no surprises that you're pretty close to your target weights as desired. And then finally, from a quick performance standpoint, these are February ending numbers. So if I would point your attention to the top half of the page there, you can see the month of February was a positive one for the plan. It was up about 2.4%. You see the year-to-date numbers, about 2.5%, running a touch higher than the broad markets are. And you do see there some of those more robust numbers in an absolute sense, the fiscal year-to-date number of almost 22%. And then you see the one-year number ending in February of just close to 26%, and a decent amount of outperformance versus the broad market. So the general tone here continues to be a constructive one on the performance front. And again, right, we'll roll in the month of March for you and have some of that detail for you in short order so we can look at the full formal Q1. With that, I'll pause for a minute and just see if the board has any quick questions on what is admittedly just a touch point on markets and performance, but happy to take any questions you may have.
I have a question.
Sure, Ethan.
All right, Ethan Goldman, member. So this goes back to my question. Are we still at the 40%, funding, or has it improved because of the investments, or where are we relative to where we had assumed we would be when the beginning of the year?
Yeah. I know, Becky, I don't know if you want to chime in there or not. But...
Well, I was actually just contemplating, since the markets have been strong, the amount of pension obligation bond in our modeling was based on an estimate of the June 30, 2021 market value. Pete, maybe get back to me on this question, but it might be appropriate to borrow somewhat less than is currently planned, because the goal is to have the pension plan be 100% funded at June 30, 2021. And if you borrow the amount based on our current analysis, the plan would actually be overfunded.
I'm sorry, Pete Privitera, Finance Director. We need to talk about that, but I think we're going to be underfunded anyways, because we can only borrow value of the past service liability, not the normal cost. So I think we're going to be underfunded after that July 1st date. Moving forward, we're going to be in the in the high 90s only because of that. So, but certainly, I'm all for borrowing less if we can, and it's probably a discussion before we issue.
Yeah, why don't we take that discussion offline? And of course, we still have 3 months to go, so bad things could still happen. But the strong performance, more fundamentally, doesn't change our outlook about the expected returns for the long term. It's great to have good performance in the short term, but our analysis about the expected long-term return on the portfolio is independent of what's happening in the short term.
Ethan Goldman, member. I'm sorry. Okay. Are we still at the 40%, or are we higher? Or do we know? And I'm not trying to throw. I realize you may not have calculated. I would just like to know.
Yeah, Ethan, we don't normally revisit the funded ratio in between valuations.
Okay.
It's also important to remember that the funded ratio is calculated based on the actuarial value of assets rather than the market value of assets. So the actuarial value at June 30, 2021 will only reflect 20% of the current year's gains.
Right.
I don't, other questions or thoughts with respect to the markets of the portfolio? I don't see any hands. Okay. I think the other quick task, and I know we're kind of running short on time here. You had asked us, you remember, and I know hopefully folks had a chance to look at this, where you continue with the dollar cost averaging pool. I think to have ongoing discussion around the investment profile of that program on the get-go. I think we all agree that it needs to be conservatively invested. And I think there's been ongoing discussion about the actual complexities of that program. And we had started, you'll remember, back in the fall, and modeled the idea of confining that pool to short-term fixed income strategies. And there was a desire from the board toward the end of the year to perhaps look at some intermediate duration strategies as well that might have slightly higher absolute yield profiles. So what we've updated for you here are a number of candidate strategies in both of those spaces. And you'd see there yields in the second column across the different strategies that we might contemplate. And then we frame them, as you might appreciate, versus their interest rate sensitivity or their duration profile, and we can calculate a yield per unit of duration, if you will, to the far right there. In a vacuum, of course, the higher that number, the more desirable, I suppose. But we fully recognize that, we earn and keep absolute yield over time in return. So the relative numbers are a nice guidepost, but they're not the only thing to look at. So we've updated those numbers through February, right? And you see there the candidate strategies. Let me go through the slide deck, if you would, and then we can kind of revisit here and see what our next steps are. The strategies, by and large, do well and earn their keep in terms of generating incremental return. They do that, as you can imagine, right, by being making active decisions around both what parts of the short and intermediate markets they're investing in, and moreover, the credit quality of those investments. It should be no surprise at all to the board, right, that those yield increments that you see over the markets, if you will, over the benchmarks, accrue from conscious efforts in lower investment grade, being a consistent place that they fish. Some of the strategies, orient with barbell in terms of the credit, but generally you see this persistence in lower investment grade, and then moreover, right, kind of corporate paper and the incremental yield associated with that being desirable, all things equal. So we know that there's that trade-off, right, that if you're going to try to seek a bit of active return over and above those benchmarks, you've got to source it from somewhere. As it comes from credit and it comes from sector. And that's a pretty consistent theme across on all of the strategies in both the short and the intermediate portions of the pool. And then moreover, we wanted to just remind the board, so you see it here, these are actual live returns through the end of the calendar year. We're starting with the short-term cohort here, and you'll see numbers that are generally and pretty consistently positive, right? Which is obviously a desirable outcome from us. You'll remember in the model, we had used a 1.5% return as kind of our proxy for the DCA pool, kind of on a run rate, right? Fully invested over the course of a year. And you see that generally has been achieved. There are, in periods of real stress, 2008 noted, there can be negative calendar year returns, negative 12-month returns. You see that there with a couple of the strategies here, but it doesn't happen very often. But we just do want to be mindful that it can happen. And if we switch gears to the intermediate bucket, that same kind of general story, right? Positive returns that generally outpace the benchmark for all of the managers that are contemplated. And then when you tease the data in a little bit more granularity, you start to see, again, just for us to be mindful of, it doesn't happen often, but 2008, 2013, you can see these one-year periods where you have slightly negative returns that accrue to the strategies. So again, just something for us to be mindful of. There's other collateral in the deck here that I'll set aside. We did roll the short-term numbers to just show you the general absence of negative absolute returns, and again, confined here essentially to the 2008 timeframe. So really severe stress markets where you might see negative returns from short-term fixed income. And then just finally, more broadly, just in terms of the profile, the yield profile for the broad fixed income markets, I think this is collateral we've shared with you in some of our other reporting. We are at a period right now, as you can appreciate, given while rates have gone up a little bit, they're still pretty darn low from a historical context. And this idea of the amount of yield you're able to achieve based on the duration or the interest rate sensitivity is, as you can see here, kind of down near historic lows. There's not a lot of yield in the markets, fixed income markets right now, as you all well know. So I think the task at hand is, as Peter kind of hinted at, and the chair hinted at, is for us to continue to explore what you would like that dollar cost averaging program to look like. Perhaps it is confined exclusively to short term. It could be confined exclusively to intermediate, maybe some combination of the two. Ultimately we'll be tasked here with, we've got those bond proceeds that come available mid-year, and we've got to get those into the program. And moreover, how, the complexion of that strategy going forward, how we might want it to look. We don't have to have those answers this morning, but I think we need to continue to tackle those collectively and have that the specificity kind of set forth in the coming weeks and couple of months so we can receive those monies and be on our way. The only other thing that I would mention is that Peter and I are kind of operationally thinking about the implications of this as well. So we have been talking to the custody bank, the Wells Fargo principal folks, and mechanically just thinking of the ways to accept those monies into the trust, segment those monies so we can kind of account for them explicitly and have, to Ethan's point, some of those separate markers along the way here to kind of keep us on task and give us guideposts as to how the program's doing. So that's all working behind the scenes as well. So with that, Madam Chair, I'll pause for a minute. I know we're kind of running into our threshold here.
Oh, that's good. This is Nancy. Quick question for you, Chris, on the custody. Will they just have a kind of a sub account with the rest of our assets that we'll be able to track what's happening? Is that what you're envisioning there?
Yeah, we're envisioning a separate sub-account within the trust accounting framework where we can accept these monies in, account for them explicitly, and kind of monitor accordingly. So yes, the answer would be to have a separate account within your current reporting framework.
And then as we invested, would they blend in over then to the corpus, or will you always keep this? Right. Okay.
Yep.
That's what I thought.
I would see, Nancy, right, to the extent we had an 18-month window, right, you would have that separate account, if you will, and we would have that set up, and it would ultimately kind of self-extinguish, right, once you've completed the averaging program, you're back to just the portfolio in totality.
Okay. I think that's good. I think I know we're going to lose Peter. I think our Milliman advisors also have a commitment to get to, so we thank them if I haven't already missed thanking them. Hi, Yelena. Are there any other questions for Chris at this point? Ethan, you're right.
Just one quick question. Ethan will remember. I remember seeing the negative fixed asset return. Was that for short term as well? I didn't remember if it was differentiated.
Yeah, there were a couple of, 2008 would have been the case for short term. For intermediate, Ethan, if you looked at the data, it can be, I think it was 2008, 2013 were the two scenarios.
I meant February, Chris, I'm sorry.
Oh, in February, yes. Short term, I think we get.
If you don't have it, that's fine. Okay.
Yeah, everything's been a little pressured in fixed income. So if they were positive, they were nominal.
I guess my one comment would be, after listening to Alan, I was originally thinking we should go longer cost averaging, and maybe not after hearing him. So thank you. That's all I have.
Okay. We have a meeting set for May 10th, I think, Rick. I think that's our very next meeting on our schedule. I think that can all hear my dog. I apologize for that. We should, I think by that meeting, have a much better handle on the actual time frame of the issuance from Peter, as well as other things. But that really should be a very investment focused meeting so that we can make sure that we're making progress on this front. But I don't see a need, unless anyone wants to have another group meeting prior to May 10th. I think we should be okay until then. Any comments or any other questions, orders of business today? No? Okay, then I will make a motion to adjourn the meeting. Thank you all for participating. Thank you, Chris. Thank you, Peter. Thank you, Milliman. Yelena, please extend to Becky from me as well. Okay. And Alan, thank you very, very much for all the extra due diligence. And we're going to give you our Diligence Award of the year. So there. All right. Thank you all. We'll see you May 10th. Right.
All right.
Thanks.
Have a good day.
Bye.